This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Exxon Mobil agreeing to buy Pioneer Natural Resources for nearly $60 billion. So this would be the world's largest corporate takeover announced this year, as well as Exxon's largest takeover in more than 2 decades, as it does seek to become the dominant producer of shale oil. So M&A, of course, has been impacted by the higher rate environment, as it does affect the cost of funding for a corporate takeover, but that clearly didn't stop this big oil deal, Molly. So Exxon CEO Darren Woods does say he expects to trim the annual cost by about $2 billion as it integrates the purchase of Pioneer. So here to discuss more with us, Alix, Bloomberg Commodities edge anchor at Bloomberg Television, on the phone from New York City, and Fernando, Valle, senior oil and gas analyst at Bloomberg Intelligence, joining us on Zoom in New Jersey. We'll get to the news in just a minute, but first, let's listen in to Alix's interview with Exxon CEO Darren Woods and Pioneer CEO Scott Sheffield.
The world's going to continue to need oil and gas for some time to come. What society should be focused on are companies that can most effectively produce the oil and gas that society still needs. It's a win for the environment because as long as it's needed, you want the most responsible operators producing it. With this combination, we will be the most responsible operators with the lowest carbon intensity.
Alix, let's start with you first. You did interview both of these CEOs. What did they tell you as to why these companies did agree to combine?
So I kind of joked with Scott Sheffield because he has tried to retire before, and he came back. But this time it feels for real. In April, he said he was stepping down by the end of this year. So I have to wonder, how much of this is wrapped into it.
Right.
But from Darren Woods' side, it truly is having this massive technological powerhouse that you're able to bring now to a massive amount of shale rock in the U.S. I mean, he was talking about 4-mile laterals. Basically, that's a really, really, really long pipe horizontally in the ground. The max that people are doing right now in shale in the U.S. is 3 miles. And this is like an Exxon thing that they can bring to this rock that they desperately need.
So we saw, Fernando, that this is going to make Exxon the largest player in the Permian, this deal. What else stood out to you in terms of highlights as far as what's advantageous about the deal for both companies, maybe some other numbers that really caught your eye?
Yeah, absolutely. I think to Alix's point, it's part of the technology. We're a little dubious that they'll get to $2 billion, but maybe they will if that really pans out. But also it's the integration downstream with this new rock that Alix is talking about. Remember that Exxon has a significant presence in the Houston area with their refineries, carbon capture as well that they're establishing now. So that's how Darren can get to that more responsible oil company, more responsible oil that he mentioned in Alix's interview. And the other point is, you guys talked about cost of capital not impacting. I think quite the contrary. It makes Exxon the preferred destination. Again, from Alix's interview, Scott Sheffield said it was the most attractive equity out of all the majors in his view. And because they have that AA rating and they are such a large player that can develop this rock at a very cost competitive basis.
Well, just to follow up on that quickly, Fernando, because I noticed this is an all stock deal. So maybe then you're not dealing as much if you were to have a cash funded portion that you'd have to tap debt markets. And so is that maybe playing in a little bit there in terms of the cost of financing?
Exactly. So all equity deal. And then importantly, Pioneer now is expected to generate about $4.5 billion in free cash flow in 2024. And the dividend burden from the shares issued by Exxon to buy it, it's only about $2.1 billion. So they actually get some extra free cash flow out of that they can use to either do more buybacks or continue to grow at a faster pace.
Hey, Alix, I want to bring you back into this conversation. Exxon has been on the lookout for acquisitions in the Permian Basin for years, but really struggled with the timing. Why is that?
Yeah, I think you're referring to its 2010 acquisition of XTO Energy, which basically called the peak in gas prices. Right after they bought it, this was really their first jump into shale, and it was a gas play at that point. Gas prices totally cratered, and they admit it. They're like, this was a terrible, terrible price and a terrible, terrible acquisition. This one feels a little different in that they're already in the basin. Like, this is not a new thing for them. And this is really about leveraging their existing technology to get more oil out of something that's already proven and that's already there. Now, you might argue, well, if you're going to get more oil out more efficiently, does that actually lead to more production, which in essence means a lower price? True. But a lot of this oil and this acreage that Pioneer is bringing to this deal, you can still get 10% return on like sub 50 oil. So it's okay as long as you don't like crater oil at the same time. And it looks like the price band for oil in that marginal barrel has kind of moved up from like 60 to maybe 80. So it gives them a lot of wiggle room at that point.
So, Fernando, you were just saying that you're skeptical of this $2 billion. I assume you meant that was the estimated cost savings, right? That's what the Exxon CEO says is going to be possible from this deal. And that's something, CEOs love to talk about that during
Right.
M&A. I'm sure Jess knows this better than anyone. They love to talk about expected cost savings, those synergies. That's a big word.
Synergies.
Love a good synergy. So, Fernando, tell us, why are you skeptical?
All right, so about half of those synergies are actually that improved technology, the recovery factor improving, and that's been a difficult battle for most oil companies, including Pioneer. The efficiency ratings on most shale wells has kind of plateaued over the past couple of years. So Exxon would have to bring something truly new, and maybe those 4-mile laterals will do it. But it's a prove to me story, as opposed to take it at its word, because to date, the cube technology that Exxon has touted hasn't really panned out for most of its peers. So we wait to see if they can actually get that improved recovery that's about half of those synergies.
Hey, Alix, what issues, if any, could arise that could make this transaction potentially fall apart?
Oh, man. I mean, lots of them. I just don't know if it's actually going to happen. I mean, you could have another major come in and kind of swoop in to buy it, but I find that to be highly doubtful. So Conoco, I don't think, would make this kind of big acquisition. Chevron's still absorbing some of its shale acquisitions. Oxy is really still integrating Anadarko at this point. So it doesn't feel like anyone's going to step in. The other part is regulatory. Now, technically, I guess you could make a say that, like, hey, this is a lot of Permian Basin with 15% of production in the Permian now. But there are just so many small players in there that it's hard to make that antitrust case. In addition to the fact, why would you block an oil merger that could unleash more oil when the U.S. is talking about needing more oil? I get it from like a green perspective, maybe, but it's going to be really difficult to make that case rather than looking to the Saudis or Iran or Venezuela for more oil.
Yeah, last one here, Fernando, just our last 30 seconds here. Tell us a little bit about, we've got a lot of oil price moves lately between, the interest rate environment and the conflict in Israel. Can you tie that into this deal a little bit right here and how that matters?
I think in the short term, we're a little worried about demand because the high prices are impacting how much fuel we are consuming globally. But then in the longer term, as Darren alluded in the interview, there's been an underinvestment in the industry, and we see a higher price, which I think it's why Exxon stepped into Pioneer now. It's a good timing for them to buy undeveloped acreage that they can then sell at a much higher price later.
Hey, Alix, we only have about 20 seconds left, but what was the most surprising takeaway from your interview with both of the CEOs?
Actually, how excited Darren was. I mean, he's pretty much like a typical, Exxon CEO. He's like by the book, right? He's going to say the things. He seemed actually genuinely excited about it, and I was not expecting that, to be honest with you, which means that there could be just more fun things coming out of this merger to come.
Right. Thanks so much for both of you joining us. Alix Steele, Bloomberg Commodities Edge anchor at Bloomberg Television, and Fernando Valle, senior oil and gas analyst at Bloomberg Intelligence.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Switching gears now to another important topic, Molly Smith, the green hydrogen economy. A little bit different. I know you and I cover the economy as well, but this is a particularly nuanced area. But the green energy transition is gathering momentum with governments in industries worldwide looking to address climate change while bolstering global energy security. So is green hydrogen the fuel of the future? Plug Power, a hydrogen fuel cell manufacturer, has been making deals across the world to create massive green hydrogen factories using electrolyzer technology with machines used to make green hydrogen. Joining us to break down the company's green hydrogen ecosystem strategy is none other than Andy Marsh, President and CEO of Plug Power, joining us on Zoom from upstate New York. So Andy, thank you so much for joining us both. I want to start off with, can you just kind of set the scene here and talk to us about what is the green hydrogen economy and how exactly does your company fit into this?
So the green hydrogen economy is really important for climate change. And let's just talk about, you mentioned mobility, but if you look at industrial applications, which represent 26% of the carbon footprint in the world, the only real solution to that is green hydrogen. And Plug today not only has the devices that take water and a renewable electricity and creates green hydrogen, but also is a company that's building out nationwide a green hydrogen network here in the United States, as well as projects around the world in Antwerp in Belgium, as well as 850 tons per day of green hydrogen in Finland over the next 4 or 5 years.
So, Andy, there was this symposium that you guys had that I wanted to ask you about, the Plug 2023 Symposium. That is this hybrid event that you hosted. Was that today? I think it was.
It was today.
Tell us about it.
It was, we had today folks from, it really is, and you mentioned it was a hybrid event. We spent about half the time bragging about Plug, but we actually bring about half the time bringing together customers, government officials, industry experts, universities to really discuss the future of hydrogen and fuel cells. We had the event today. We had two really fascinating announcements. One is in Australia, where we are partnering with Fortescue to do 550 megawatts of electrolyzers, as well as building plants here in the United States with them for green hydrogen. We had another exciting announcement to Arcadia in Denmark for sustainable aviation fuel. But this afternoon, there were 18 breakout sessions looking at energy transition, different applications for fuel cells, as well as the profitability of this industry long term. We had over 150 people here, and I think I'm a little shortchanged because it was packed beyond our number of chairs, as well as over 2,500 digital viewers in the morning.
So who exactly comes to that particular event? Are there particular executives and companies that tend to attend?
Sure. So you see, as I mentioned, a wide variety. So, for example, we had UC Irvine here, Dr. Jack Brower, who runs the fuel cell, who's director of the global fuel cell activity there. We've had people from Tyson Foods. We have people from Fortescue. We had people from throughout the industry. Amazon was here. So we had lots of customers here. We had government officials from New York and West Virginia here, as well as other states. So it's really a opportunity for us all to sit around and talk together about the direction of this industry.
Yeah, you mentioned Amazon as a customer. I think Energy Vault is another. Can you tell us what exactly you sell to them?
Oh, sure. We sell a variety of items. We sell hydrogen itself, and more green hydrogen as our green hydrogen plant in Georgia will come online. We're providing hydrogen as a fuel. In Europe, we have deployments going on with our JV with Renault Hyvia for doing last mile deliveries with a vehicle that was which is homologated in Europe between ourselves and Renault. We have forklift trucks and distribution centers, over 60,000 of them to date. We've built over 200 hydrogen fueling stations for them. Those activities with those big customers are probably some of the best kept secrets in the world.
And tell us why, maybe without spilling, the big secrets here, but tell us a little bit, why does Amazon want hydrogen? What's in it for them?
Sure. So let me take a step back. There's a value proposition. And the value proposition with Amazon is they can move more goods faster by using fuel cells versus batteries. Whether it's in a vehicle, you can charge it faster, you can fill it up like a gas tank in minutes, not having to wait hours. So you don't have to waste time with your assets sitting for a battery charge. They have goals for their carbon footprint, which Plug Power helps them achieve. So a combination of those items, plus the fact we're looking at stationary products, about how hyper data centers in the future. Last year, you may have seen some of our announcements with Microsoft, where how you turn data centers into not only having diesel generators to back up the buildings, but using hydrogen and fuel cells, which actually provide power when the grid pricings are higher, much like peaker plants today for natural gas turbines. So we make them green, we do it cost effectively, and we help their core business of moving goods faster.
Molly and I were actually chatting about ahead of this segment when we were talking about the green hydrogen economy. And of course, because she and I cover the Federal Reserve and obviously the economy and the stock market, and trying to kind of make sense of how does this play into where the global economy is headed. I know a lot of people focus on sort of the path to net zero by 2030, but your view when it comes to climate change and the global economy, how do you see that right now? And how does that fit into the global economic landscape?
Sure. So folks at Bloomberg actually believe 20% of the world's energy by 2050 will be green hydrogen. And when I look at it, the path between now, and I'll just use Europe as an example. On Monday, Europe passed 27 nations agreed, which I find an amazing fact, with a renewable energy directive, which is looking to have over 10 million tons a year of 10 million tons a year of hydrogen internally produced by 2030, which would use our products like our electrolyzer products, as well as use hydrogen from plants we're building, and another 10 million tons imported into Europe. So and when Europe set those goals, 42% of that hydrogen has to be green. So, you take a look and say where it's going, but you also seeing governments in Europe much more of a stick approach, saying companies have to do this. Here in the USA, obviously we have the IRA where the regulations are being finalized for hydrogen, which I know the government's working diligently on at the moment. And I think that'll be really beneficial to accelerating green hydrogen deployments here in the States.
Hey, you brought up the government. I just want to quickly, because we only have about 20 seconds left, the Inflation Reduction Act, how does that impact green hydrogen industry?
Significant. There's a $3 tax credit for green hydrogen. Government's working as hard as can be to make sure those regulations are right. We've been supporting the efforts, and I've been really impressed with their knowledge. And, I know some folks are complaining and wish it was done now.
Right.
The fact of the matter is they're working to get it right, and I support the efforts they're doing.
All right, Andy Marsh, CEO of Plug Power, joining us here with Molly Smith and myself on building an end-to-end green hydrogen ecosystem.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Now, Molly, I'm not sure about you if you're planning any sort of holiday travel plans. When I think about last year, it was pretty chaotic, but it's coming up sooner than we may think.
Yeah, and I think we got to get really on it. Our next guest is going to tell us all about this, but you really need to start thinking right now if you are going anywhere for Thanksgiving or for Christmas.
For sure. And according to the experts at travel booking site Hopper, they are recommending booking Thanksgiving and Christmas travel no later than October 14th. So if you do look at the calendar, Molly,
Saturday.
That's just days away, right?
This is stressing me out.
Exactly. In order to basically try to score a good deal this holiday season. So who better to join us right now? Hayley Berg, lead economist at Hopper, joining us on Zoom from Boston. Hayley, thank you so much for being patient and joining us and sticking with us here. Now, break it down. What should we expect to pay for the holiday travel season this year?
Right now, airfare for Thanksgiving is hovering around $270 for a domestic ticket that covers the Thanksgiving dates. And that's down about 14% from last year. So the good news is if you traveled for Thanksgiving last year, you should expect to pay a little bit less. The same is true for Christmas. Christmas is always a lot more expensive than Thanksgiving. It's averaging about $400 per round trip domestic ticket for this Christmas season, but that too is down from last year about 12%. So though there might be a little bit of sticker shock coming off of a big travel summer, these prices are actually a lot better than what we paid last year.
So then, Hayley, does that mean, are you expecting this to be a pretty busy season then in terms of travel?
Absolutely. Absolutely a busy travel season. Last year was the first holiday season where travel was fully open post-COVID. And this holiday season is where we're going to see international travel really come back to pre-pandemic levels. So we're expecting that domestic traffic will be high as folks head home for the holidays, but we'll also see a lot more travelers heading on international routes for some of those bigger bucket list vacations that stretch over time off at the end of the year. So definitely expecting a busy holiday season, and that will drive up last minute prices, but prices are still pretty good right now.
Okay, so tell us, what are the cheapest days to book and when to go?
Booking wise, you want to book now. Two reasons. One is prices are on average about as low as they'll go before both holidays, Thanksgiving and Christmas, today. Prices will start to rise after this weekend, slowly at first, but then they'll really ramp up at the last minute. So you'll want to book now, both because of price, but also availability. It'll be a busy season. Flights will sell out. The best way to find a really great deal at the holidays is to fly on those less popular dates. You can save about 40% off of your Thanksgiving airfare just by skipping the Sunday return flight. Try to come back on Monday after the holiday weekend. Same goes for Christmas. Try to skip those most popular dates like Thursday and Friday before the holiday weekend, and you can save anywhere from 20 to 40% on your airfare. So fly on the dates that you think fewer people will be flying, those less popular dates, and you can really pack on the savings.
You know, those are the days I would think are less popular, but I feel like the, hybrid work here has changed a bit of that, right? Because a lot of people now, they can work from home that Monday or Friday, maybe can fly, those like Thursday night or Monday night flights that you said would usually be less popular. But is that still the case, would you say?
Prices are still low for those off-peak dates, but you're absolutely right that we are seeing some shifting of travel preferences with the normalization of remote work. Definitely among Hopper users, our users are typically Gen Z and millennial who tend to have a lot more flexibility, are open to being more flexible in when they fly or where they fly. So we definitely see some shifts beginning in when people are traveling. But the reality is a lot of Americans do need to either have their kids in school or be at work and won't have the flexibility to fly on a Wednesday before Christmas and come back the following Wednesday. They'll live more by those traditional schedules. So though we see some shifting trends there, on the whole, the most popular dates for holidays throughout this year, especially the end of this year, have remained pretty much the same to what we usually see.
We've heard from airliners in the recent past 2 months end up cutting their outlooks for the third quarter just because of how they were impacted by higher fuel costs. We will hear from Delta Airlines reporting results in the morning. How much of a threat, when you're thinking about higher fuel costs when it comes to airlines and potentially pushing up the costs for travel fare when it comes to buying those tickets, are you worried about in the next coming months?
We have been worried about jet fuel for the past 3 or so years, it seems. It has been so incredibly volatile. But really what we've been thinking about, especially from the consumer's perspective, are two things. One is we really need to see sustained and significant increases in jet fuel prices for consumers to truly feel those in their wallet. Airlines pass on a proportion of those jet fuel increases to travelers, but there are a number of other factors that are going into pricing. Demand, even the plane that's operating on the route, it all goes into, the efficiency of the fuel, how much it actually costs and how much that's passed on to the consumer. So we would be looking for a really sustained increase. Fuel prices have plateaued. They have increased in the last 3 months or so, but have plateaued in the last couple of weeks. So we're hopeful that the holiday season will be protected, especially if travelers book now. But if we see any sustained increases into next year, we may see slight uptick in prices. I would expect long haul routes would feel the impact a bit more than domestic.
So Hayley, when you're saying though that you still think this is going to be a really busy travel season, I mean, that to me just sounds like the consumer is really strong. And obviously we've had, that really is the bone of the economy right here. So what does that then tell you, maybe not just for the, fourth quarter outlook, but looking a bit further ahead and how, resilient the consumer is right now?
Travelers have been incredibly resilient in the last few years. And I think something that we're really seeing mature is these younger generations and their prioritization of travel expenditure. Millennials, Gen Z, the millennials are now in their early 40s. They've built wealth and they consistently prioritize expenditure on travel, even as they tighten their belts. And I think we're seeing the result of that, even as we head into the fourth quarter of this year with holidays, lots of spending ahead, and consumers still concerned about the economic outlook. We expect to continue to see travel being prioritized, not just from these younger generations, but they're certainly leading the charge. And that gives us a lot of, positive momentum headed into 2024. And we're expecting, another strong holiday season, but also expecting to see strong signals for spring break and summer 2024, especially to some of these destinations that are new and trending and interesting among the younger generations.
Hey, Hayley, we only have about 15 seconds left, but to Molly's point, do you really think we're headed for a recession with what you're seeing with travel?
When it comes to travel, people are going to keep spending. That's what we're expecting and what we've learned in the last couple of years. So we'll see about the rest of commodities, but I think travel is one that will continue to grow.
All right, Hayley Berg, lead economist at Hopper on Zoom for Boston. Thanks so much for joining us. We'll have more coming up. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Jess, Menton, and Molly Smith here for Carol Massar and Tim Stenovec in the Bloomberg Interactive Broker Studio. We have just under 20 minutes left to go before the closing bell, checking in on the S&P 500, up about 0.3%, trading around 43.72. Now, diving into today's price action in the markets, joining us here, Jim Gold, co-founder and chief executive officer from Steward Partners, joining us in the Bloomberg Interactive Broker Studio. And you were just talking to me about how when you were a financial advisor in the 1990s, something that really struck you, especially during complicated times, and there were a lot during that decade, about how kind of impatient a lot of clients would get when financial advisors would obviously position a certain way, and they were just eager for those kinds of strategies to play out. How do you view today's markets?
Yeah, I think it's a similar challenge, right? You think about asset allocation, and our advisors are folks who've been doing this for 2 or 3 decades, are certified, accredited, and you say, hey, we have asset allocation, and when fixed income doesn't do well, the equity markets will, and vice versa. Now the clients go, well, it looks like neither one of them are doing well, and that's true, right? So I think there's this impending recession that we're all talking about that seems to be out there but doesn't want to actually come to shore.
Right.
And so it's when you're dealing with people's money, obviously it's an emotional thing. And I think when their days feel like weeks and weeks feel like months, where they're kind of going, well, okay, but you kept telling me this was going to happen. So they stay the course and they're going to be fine, but I think it can be challenging at times to keep them aligned with that.
Yeah, so how do you assure those people, Jim? Because like you said, this is sensitive. These are people's retirement savings, their whole life earnings here, and you're looking at a lot of red on the screen. So what do you tell people in the meantime? And, is there anywhere that you can really hide out and maybe get some green right now?
Right. Yeah, I think, listen, you have to, I think being a financial advisor, you're really a counselor, right? And the money is obviously the most critical piece of it. Most of our folks have been working with their clients in some cases for decades, sometimes we're on to the third generation. So they've lived through it enough, it truly becomes like a marriage where they say, hey, there's good times and bad, and we know these are the tough times, but you've always come through for us. I think it's also a time, though, where people do lose patience with their advisor, and it's usually a great time for, as an advisor, if you've done a great job and you have a loyal client base, the better producers actually grow dramatically during these times, because some advisors aren't picking up the phone when the client's calling to yell at them because the screen's red all the time.
Well, especially because now if you look at the correlation between U.S. stocks and bonds, it's actually the most closely tied in about a quarter of a century. How much does this impact the 60-40 portfolio strategy?
I don't think it changes much. I think you have to stick with what's working, and I think the right clients with the portfolio are going to say, hey, look, I look at the screen as red, and I may be down, but I started with 4 million. I still have 7. Yes, at one point I had 9, and 9 felt better than 7, but we're going to get back to 9. So much tougher if you start at 9 and you're at 6, and you have this great plan that's clearly not working. So definitely episodic and challenging at times.
So Jess first asked you about how this environment feels similar to the 1990s, and we obviously had an early recession then, earlier in that decade. Had a few more since then. Yeah. Obviously, the financial crisis, a big one of them, beginning of the COVID crisis. What other similarities, differences you see when you're looking at today's climate?
I think it's just the extraordinary extremes we're seeing, right? So in the 90s, you had this valuation lift that went through the roof, and every year all the strategists have come out and justify why it should continue to go higher. And if you were a value investor, which I tended to be when I was an advisor, I was early in saying, I think this is a little bit absurd. And I always talk about, having been a Smith-Barney guy, I think Sandy Weil said it best in the late 90s. He said something like 80% of all the tech companies today will be out of business in 10 years, but the 20% that are going to be left will be worth more than all of them combined, right? So I think you're seeing that challenging time and trend, but I think it's the real jump in valuation. We've gone from 0% interest rates to where we are today, which I don't know if there's a time where it's risen that quickly in such a short period of time.
And speaking of those interest rates, not surprisingly, obviously that really impacts M&A activity, but what about in particular when you're looking at RIA M&A? What are you seeing there?
Yes, we have a corporate RIA. We're actually just ranked as the 19th largest in the world in less than 10 years. So what we're seeing is, and this and all the industry data supports this, is you're seeing a divergence, I think, of overall valuation to the upper end. So these sort of platform providers, 10 years ago, if you had a $2 or $3 billion RIA, that was a big firm. Now 10 billion is kind of the new 2 billion. And what you're seeing is, if you think about there are 15,000 RIAs today in the United States, is the largest number ever. 80% of them, or 12,000, are $500 million or less. So traditional deals have been, John is buying Jane's practice or Jane's buying John's practice, right, and they're financing that probably through a local bank or a smaller banking entity. Well, that drag of the cost of financing is meaningful now. So what you're seeing, and all the industry data supports it, is that the overall valuation hasn't come down. It's like saying, think of American real estate. You might go, well, Florida's still not going down, but other markets are coming down. So the overall valuation has not come down, but the real decline is on that under $500 million tier. And the ones that are actually increasing in size and valuation are the larger firms, which are the sort of $20 billion plus players. So volume's down a little bit. We're actually in front of a number of opportunities, but I think there's still an opportunity to grow it.
What do you think that tells us about the economy?
I don't know. It's a great question. You stumped me there.
Well, you were just mentioning, Jim, some of these opportunities you're eyeing. Maybe you can elaborate a little more there for us.
I think, listen, we're looking for opportunities. I think in the industry, look, you have a bunch of factors coming into play. I think you have increasing regulatory pressure, which is always out there, and you have to run a clean business and make sure you're doing the right thing by the clients. It's harder and harder to run the business. Now you think about technology and cybersecurity and operations, compliance, now economics and finance of your business. So what you're seeing is that trend, which is leading the smaller players to want to roll up into something bigger. We happen to benefit to be on the right side of that trade. I think the demographics are there as well, right? You see the average advisor age continues to go up every year, even though there's more and more under 40 advisors coming in. It doesn't seem to pull the number down because you have this huge pool of sort of the advisor baby boomers, if you will, that just keep pushing that number higher.
We only have about 30 seconds left, but because this is Bloomberg, what do you think the Fed is up to next? Do you think the Fed's actually done from here? raising rates?
Listen, I'm a long-term trend guy. I think rates are obviously going to come down. I think they're going to go up. I think they're going to go up before they come down, but I think we're going to see in a few years everything tends to revert back to the mean. I think the norm will come back in place, but we're probably 24 months out from that.
All right, Jim Gold, co-founder and chief executive officer at Steward Partners.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.